The UAE's biggest bank just delivered its best ever quarter, and if you only read the half-year net profit line, you'd never know it. That's the tension in this print. On a 6-month view, FAB's bottom line barely moved. But zoom into the second quarter alone, and pre-tax profit jumped 16% in 3 months. Same bank, two completely different stories, and which one you believe decides how you read this stock. Officially reported, quarter 2 pre-tax profit rose 16% versus the first quarter and 6% year-on-year, with operating profit topping 8 billion dirhams, a record quarter. Across the full half, operating income grew 7% and net interest income climbed 14%, though half-year net profit rose just 1%. My read, the engine is accelerating. What's mudding the headline sits below the operating line. So why is net profit almost flat while the business is clearly growing? 3 forces, and the order matters. First, the core is genuinely firing, yet net income grew double digits on higher volumes and better margins. A bank lending more and earning more on each dirham. That's the healthiest kind of growth, and it's why management called Q2 a record. Second, the gap between operating strength and reported profit is deliberate. Fact. The bank told us it further enhanced management overlays this period. Extra provisioning buffers set aside by choice, not forced by bad loans. My interpretation, FAB is choosing to bank caution instead of profit. Note the tell. Excluding those overlays, pre-tax profit grew 8% instead of 3%. The underlying number is more than double the headline. That's a bank sandbagging in an uncertain environment, and for a long-term holder, conservatism at top of a cycle is a feature, not a flaw. Third, the mix is shifting towards the paths you want growing. International revenue jumped over a third and now drives more than a fifth of the group. Investment banking, global markets, and debt capital markets all posted strong double-digit gains. My read, FAB is becoming less dependent on the UAE rate cycle and more on fee-based cross-border flow, a higher quality revenue base than pure domestic lending. Now the honest counterweight. ROTE, the number that actually measures shareholder value creation, slipped from last year's level, still comfortably above FAB's own target, but the direction is down and equity is growing faster than profit. Deposits were nearly flat year to date, while loans grew 7%. So funding is something to watch, and flat net profit line overlays or not is still what hits the tape. Does management sound confident? Yes. Measurably so. They reaffirmed full-year guidance, said loan growth should finish at the upper end of the range, and pointed to the tightest ever spread by a GCC bank on a Tier 2 issue. My read, that's a management team leaning in, not bracing. My assessment, this quarter strengthens the long-term story rather than changing it. Strip out the deliberate provisioning, and FAB delivered its strongest operating quarter yet, with the growth coming from exactly the higher quality international and fee-driven places you'd want. Before next quarter, watch 3 things: whether ROTE stabilizes or keeps drifting lower, whether deposits catch up to loan growth, and whether those management overlays get released back into profit, because the day they do, the reported number snaps toward the underlying one. Record quarter, cautious optics. That's FAB this time.